Most of you here today know Debashis Basu. He is the founder trustee of Moneylife Foundation. He is also the editor and publisher of Moneylife, and he is also a chartered accountant. He's got 29 years of experience as a journalist. He's worked with most of India's leading publications, including Times of India, Business World, Financial Express, Business India, Business Today, and he now writes a column for Business Standard. In the past, he's written columns for the Economic Times. I now hand over the mic.
My presentation is very short. That's because there's hardly anything significant to add except to reiterate what I have been saying for a very long time. But I would like to start by giving a little bit of overview on the on the economic state that we are in, and because that sets the expectations. A lot of us very glibly say the finance minister should have done this or should have done that, and for at least for a day of the budget day we all turn into expert economists. But here are some numbers, and I'll share a pie chart with you about which gives you a snapshot about the Indian economy, or rather the finances of the Indian economy. Now, the fact that, a simple fact that we must recognize all the time, that we are overwhelmingly dominated by the presence of the government in a variety of ways, all right? Some of us benefit from it, and a large number of people don't benefit from it. Those who don't benefit from the presence of a big government are faceless people, small people, the marginal farmers, the poor people. They have no voice. But ultimately, the impact of the big government and the way the Indian government is growing and growing and growing, ultimately it results and it affects them through one number, and that is inflation. And you found it's so difficult for the government to control inflation even after Modi has come, and various measures and various things are being talked about, but I can guarantee you it's going to be extremely difficult for us to control inflation if we don't control the big government. And that's fundamentally because the government is inefficient. It does not earn as an entity. It merely spends. It collects taxes and it spends on a variety of schemes. Its expenses are all fixed. If you had a company like this, it will go bankrupt in no time, which doesn't earn its keep, which doesn't earn a surplus, and its expenses are constantly going up and up and up, because most of the expenses are indexed to inflation. Most of the money is being spent in defense, salaries, and huge amount in interest costs. And this is being funded by more and more of loans. We don't see any of these numbers. Once in a while, you will see a little snippet in a business paper saying government has auctioned, RBI has auctioned so much of loan for the government, or you will see the LIC has, funded the government. They bought some Government of India bonds, and therefore they have funded the government. This is how the government gets its money. Now, all that money is needed. It's like a monster which is constantly needs money to feed itself and remain at the size that it is. The two main sources of revenues for the government is raising taxes. And in the budget estimates this year, the finance minister has said that the tax revenues are going to go up by 19% this year. If the economic growth does not take place, it means that it is going to be more danda to extract that money. 19% has to come. If 19% doesn't come, the budget estimates and all the numbers that you're looking at, including the 4.1% fiscal deficit, will go haywire. A budget in the beginning of the year has to balance. So in the budget highlights, you will see this is the revenue and this is the expenditure, and they have to balance. Somewhere down the line, a few months later, the balance goes away because either the revenues have fallen short or the expenses have gone up. There's no getting away from this. This is pure arithmetic. Okay? As the budget stands today, it budgets for a 19% increase in revenues. And it budgets for some 50,000 crore. The figures keep changing. I read 43,000 crore of PSU share sales, and I read 50,000, and the finance minister has said it's going to be 70,000 crore or whatever. So these are two key figures. If the revenues fall short, or if the PSU share sale does not raise the revenues that the government is trying to raise, the books will not get balanced. There's going to be more expenditure and less revenue. It's as simple as that. Now, because of this, we have been constantly facing, and this is nothing to do with UPA, this is a constant across all governments. inflation in India is always at 8%, 7% or so, unless we have a recession. If there's a recession, there's no demand for goods and services, which we saw in 2001, 2002. The prices fall, you have a lower inflation. But even then, in the West, if there is a lower demand, the inflation goes down to even 1% or 1.25%. Even in India, despite there being a recession in 2001 and 2, even then the inflation was 5%. All right? And that is all because the government needs a fixed amount of money. Now, this is the pie chart that I was talking about. Please take a look at this. On the left-hand side is where the rupee comes from, and on the right-hand side where the rupee goes. All this is very important for two reasons. To set our expectations. What is the challenge before this government or before any other government? I'm not taking any sides or any sort of ideological position over here. I'm saying this is the government that we have today. And it was more or less the same thing maybe 3 years ago or 5 years ago, a little more or less. The single most important element on the left-hand side I would want you to see is borrowings. The borrowings is 24 paise per rupee. And the single most figure on the right-hand side is interest, which is 20 paise per rupee. Now just translate this into lakhs that we can understand. Suppose there's a household which has got 10 lakhs of income and 10 lakhs of expenditure. It has to balance, right? Its budget. This means every year, or this particular year, and this is the same story year after year, it has a 2 lakh interest cost. A 2 lakh interest cost at 8% means this household has at least 25 lakhs of borrowing already existing, on which it is paying at an 8%, it is paying 2 lakhs of yearly interest cost. And only one figure on the other side is 2,40,000, which means to pay 2 lakh of interest, it has to borrow 2,40,000. That's it. There's nothing more as a citizen of this country, as an investor, as a saver that you need to see. So if this budget has to improve any materially from what it has been in the past, either this 2 lakh has to go down and then this 2,40,000 has to go down. There is just no two ways about it. If it has to go down, there has to be other sources of income. Now, Mr. Patel has written, he's actually coined the term taxtortion, okay, which we've used in our cover story. If this goes on for a while, the government will have to do more and more and more of extraction of taxes, which we call taxtortion, from that corporation tax, 21 paisa, income tax, customs duty, union excise duty, service tax. This is really its only source of revenue. There's hardly much you can get out of non-tax revenue and non-debt capital tax receipts. This is your real source of revenue. So if you can't reduce your borrowing, and if you can't reduce your interest rate, this is the only source of revenue that you have, which you have to extract more and more and more. This can give you more, provided there's a huge boom in the economy. So without doing anything, in 2005, 4, 5, 6, the government of India, without doing anything, because the economy was coming out of the recession of 2001 and 2 and 3, and there was a natural rebound in the economy. The supply was less, the demand was much more. Huge amounts of money was coming in from the foreign countries as FII money, because the stock market was doing well. Without making any changes anywhere, the first UPA government had the advantage, a pure lucky fortune, lucky stroke, pure fortune of having higher and higher revenues because of manufacturing and service activity that was going on in this country. It can happen only once over a cycle. It can happen only once over 15, 20 years. After that, you go back to where you were, which is a normal growth in revenues, a normal rising taxes, and you having to go back to the market to borrow. If the government of India is in the market to borrow all the time, perpetually, there is no way interest rate will fall. Because that's like the elephant monster in the room. It has an endless, insatiable demand to borrow. Today, if you notice, the stock market has gone from 6,200 or 300 or whatever to 7,700, 7,800 almost, because Modi has come to power with huge expectations. Bond market has not moved at all. They don't care. They only want to see whether there is less borrowing or less demand for money by the government of India or not. There is no sign as of today, and I don't know how that sign, where that sign is going to come from. This is pure arithmetic. There is no sign till today that the government will borrow less. The government will borrow less only if, apart from these taxes, it finds a third source of revenue, which is outside their borrowing, which is outside the taxes, which is what is called capital inflows. Let's say it is trying to sell shares of public sector banks, or if it is able to develop a huge surplus land lying with railways, or if it's able to develop land lying with port trusts. This is a third source. No government has done this. No government has bothered to touch any of these non-tax, non-borrowing sources of revenue. And this is the only thing, and you can again do it once. You can still get a government which will do all of this once and then spend it on all kinds of schemes on the right-hand side, including your 20% on borrowing, and then you have no land also, which you developed and sold for one time. All right? So it is not a pretty picture that this government has inherited. It is not a pretty picture that India ever had. It's not a question of this government or that government. As long as you have a structure where the government is big, salaries are huge, pension liabilities are huge, defense expenses are huge, as you can see on the other side, and as long as you have interest payments which are huge on borrowed money, the situation is not going to change. This is like a debt-ridden, bankrupt household which needs to borrow constantly to pay for its earlier debt. Now, what was the significance of this budget? All right? I mean, you can discuss about this provision and that provision, but for me, the big change in this, that Mr. Narendra Modi was not supposed to be in the mold of any other politician. And I have drawn by very carefully noticing and watching his campaign, and on which very little, frankly, has been written about. I saw only one article, and that too not in the mainstream media, in a publication called Economic and Political Weekly, how the campaign was conducted. Obviously, the article the EPW is a leftist magazine, so, it was all very negative. But I could see the incredible amount of planning that went in. He brought in enormous, goodwill among businessmen because of his track record in Gujarat. He brought in incredible branding and marketing, which is for the first time in this country, innovation in the way he campaigned, technology, which is phenomenal use of technology, and incredible meticulous planning down to the grassroots about who's going to man the booth, who's going to vote, the vehicles which penetrated deep into the villages, which no mainstream media wrote about. It was an incredible campaign. So we thought that some of this would obviously get translated to running the economy. When he came, these were the hopes. Short term, long term, these were the hopes. The tax laws would be simplified. All right? Government expenditure would be controlled because, as I said, for India to really become better, for the Achhe Din really to come, this is really the point number 2 is really the crucial point. Fiscal deficit would be reduced. As a result, inflation will go down or at least be controlled, because India is a growing economy. It's very difficult to bring inflation down to that level. Interest rates will go down, which is a very reasonable expectation. Bottlenecks to doing business will be removed. This alone can create a 7%, 8%, 9%, kind of a growth, which will then lead to huge tax revenues, which all finance ministers want. Growing at 12% and 13% is not an abnormal thing. Many countries in the world have done it. If you go back and see the rate at which Taiwan grew after the Second World War, it was for years together a double-digit growth. Exactly the same way Japan grew in the 60s and 70s. It's not such a big deal to be able to do it. But for that, India rank in the way it does business. There is a website called doingbusiness.org. You should go and check where India ranks in 6 parameters of doing business. 182 countries are surveyed by the World Bank. In all of these 6 parameters, we are in 152 somewhere. We are in 170 somewhere. In one factor, we are at 181. We are one of the lowest, second lowest from the bottom. If this is what happens, you're not going to get growth, the kind of growth which can then lead to lower borrowing and lower interest rate. All right? Now, obviously, the first question is that what can happen in 45 days? Surely, nothing can happen in 45 days. But this is the reality, the realization, the public communication that this is where we stand and this is where we want to go is the least that should have done in this budget. Instead, you look at this budget, the length of it, the depth in which he's gone into different kinds of provisions and sub-provisions, including, all the excise and customs changes that has been done. There is absolutely no realization, there is absolutely no admission that A, we have to reduce the big government, B, we have to improve the quality of doing business that will actually lead, because the boom is not going to be created by public sector companies. The boom is not going to be created by government departments like Post and Telegraph. The boom is going to be created by millions and millions of small business, professionals, entrepreneurs across the country, including farmers. All right? And they are today, if you talk to anybody in this room who has run a business, they are just completely fed up with incredibly complex laws that is bogging down business, and it's people want to do business, but once they started, they realize how incredibly difficult and irritating it is to do a business in this country, including a place like Maharashtra, which is supposed to be the better of the lot. No steps to simplify tax laws. Mr. Amit Patel has very politely said that he will do this retrospective amendment only to get the Vodafone money, and after that he won't do anything. I don't know whether this is correct. 1962 is the time the income tax law was formulated, so everything goes back there. 1962 is also the year we had a war. And 1962 is also about that Henderson report on which Mr. Amit Patel is Arun Jaitley has quickly gone back, removed all the posts from his blog posts and so on. So what he'll do and what he'll go back, we don't know. We want to see results, and the results are not yet there. His steps to simplify tax laws has not come. Government expenditure not controlled. Not at all. Government expenditure, in fact, is going to go up this year. Fiscal deficit. 4.1% is the deficit figure of Chidambaram, not of Arun Jaitley. 4.1% is a fiscal deficit by not paying the bills and passing it on to the next government. This government has taken it as a challenge to stick to that 4.1%. I have no idea what was the compulsion to do this. They could have said, these are the bills we have to pay. This year, sorry, it's going to be 4.7%. India is a country that world, even today, we are not Zambia, the world still wants to do business with. If you give them a roadmap and say, this is how we want to do, this is how we want to reduce our expenses and borrowings, the international credit rating agencies would certainly accept. But you took that fraudulent 4.1% figure and you want to do Heropanti about it. I don't know what was the reason to do it. As I already said, 19% increase in tax revenues, inflation and interest rate for the foreseeable future is not going to go down. And this is a statement that I'm making. Those who understand economics, those who understand bond markets, those who understand equity market would know what I mean. That inflation is not going to go down. Interest rates are not going to go down with this kind of a budget. And I don't think the next year's budget, given the commitment that Finance Minister has made to stick to 4.1%, he has to go for higher revenues. He has to push CBDT, and therefore the tax officers down the line to collect more and more. Businessmen are going to get disgusted very soon about this kind of a targeting. Bottlenecks to doing business is not just not addressed. I was aghast to see that 10,000 crore venture capital fund the government is going to give away. A lot of people are saying in Twitter and other places, this is the money, this is a reward that Narendra Modi is doing for those people who have helped him. I don't want to get into the blame game, but I know for sure, I have looked at venture capital business for the last 20 years, since 1988 when Canara Banks launched venture capital funds. Since then, I've been interested. I've done a report for SEBI on venture capital business. This is the most ridiculous thing one can ever come across, that the government is going to set up a fund for venture capital. When we have venture capital funds, they don't want to fund for anything less than today $10 million because they want to have an exit. And we already have a SIDBI which has been running venture capital fund for the past 15 years, where there hardly been any exits. You don't have a stock market, you don't have a smaller companies market, and you want to pump in 10,000 crores. Where will this money go? And how will those who have taken this money produce returns being driven by your market value, which is ultimately where the venture funds makes money. So I don't know who's advising this finance minister or this government. This is the most ridiculous idea I would have ever come across. Even the previous government hasn't done this. Taxpayers have, of course, got some concessions, which Mr. Patel has talked about. Now, this has got great implications on the various asset classes that we normally track. We had a program sometime in June, I think, and I had mentioned I had taken into account in all of these challenges, and I certainly didn't want to see in the budget a complete point-by-point blueprint till the last penny. I wanted to see a direction. I wanted to see a direction of doing business being easier. I wanted to see a direction how the government is going to be smaller. That I didn't find. But in June I had said the faster we cut expenses, the better. This year's budget, please do not expect much. Arun Jaitley may be a wrong man. This is another thing that I talked about. A lawyer is not needed over there. Somebody else may be needed. Maybe a businessman is needed, for all you know. Expect changes from the next year. And I had also mentioned that this is a marathon run for this government. So it was not that I was expecting changes in a very major way. But my point is, after this budget, the run has not even begun. This is what I personally feel. What are our investment options now? Fortunately, all of this is going to affect very badly those who look for fixed income. Okay? Equity markets run with their own logic. They run much ahead of time, then they fall back. Good stocks completely defy all of these things because they have an earning power, an earning potential. There are stocks, high quality stocks, which were identified 3 years ago, which have gone up, 100%, 150%, even during UPA 2. So equity market has a character of its own. It's a market, it's not stock market, it's a market of stocks, and we should stay focused on high quality stocks. But let me just summarize very quickly what are the investment options now. From our perspective, we believe, and those who have been associated with us for years now would very well know that we believe in two things. One is keep it very, very simple. Financial products are designed to be complex. The companies make them complex. The intermediaries make them complex because they have their vested interests. They want to sell more. If they can't confuse you, they can't sell you more. If they tell you only to buy term plan, then of course, 80% of the insurance industry will close down. So obviously they don't want to, it's in their own interest not to do that. And second point, less is more. Fewer products, better quality of portfolio performance or outcome, in whichever way you describe it. Now, taxpayers in 20% plus tax bracket. The first element in deciding which products to buy is first figure out in which tax bracket you belong to, because that determines almost everything other than, of course, equities. Because your first objective has to be that if I earn a lakh of rupees, the government shouldn't take away 20,000 from this. Because earning 20% of that figure is not easy. People earn 8%, 9%, 10%, 15%. So if you are from your taxable amount, if you're not able to save from the government, then what's the point? So you have to, if you're 20% tax bracket, you have to first go for tax saving products. And for tax saving products, PPF, ELSS, for tax saving as ATC, they remain perennial favorites. This government has increased it to 1.5 lakhs, which is wonderful. For fixed income, there are tax-free bonds. There's just no need for anybody to look at anywhere else. These are traded in the National Stock Exchange. Some are more liquid, some are less liquid. But for my life, I cannot figure out why people, anybody, anywhere, if they're taxpayers, would want to look at anything other than tax-free bonds. These are all issued by government companies like REC and National Housing Bank and so on. The liquidity will increase because over a period of time, the more and more people have now warmed up to this tax-free bonds being traded in the market. The yield is around 8.5%, 8.4, 8.6, depending on the rating. All of them are from public sector companies, so ratings doesn't matter according to me, because nobody is going to lose money by investing in a public sector company in this country for a very long time. And if for whatever reason, if interest rates fall, the values of this tax-free bonds are going to go up. So this is absolutely the right time to buy tax-free bonds, and there's absolutely no reason to put your money in something like a bond fund where you are at the mercy of a bond fund manager to choose the right securities at the right time for you, and you're getting a average of the performance through a portfolio of products. This is a product that you can identify, you can buy. It's almost like a stock, and you are in control of what you bought rather than being dependent on a fund manager. Somebody was sharing with me that over the last 1 year he has invested in, just before this meeting, invested in some dynamic fund, and the return has been 2%. It was a no-brainer to buy a tax-free bond rather than a bond fund. For growth, of course, equity funds and stocks remain the one and only option. 1 year capital gains remains tax-free, thankfully, and there's no confusion over there. Good quality stocks hold for 1 year. Your moment you're in a tax-free range and you've earned a certain amount of income, you're mentally absolutely on the right track. Non-tax-paying savers, PPF, bank FD, guaranteed, absolutely no reason to look at anything else, and of course equity mutual fund. Now Amit has touched upon taxation of non-equity funds. I'll just sort of repeat this, but it's a summary. Before the budget, equity and equity mutual funds, of course 0% remains so. Gold, real estate, long term was 3 years, 20% plus indexation. Bond fund, non-equity funds only, which is MIP, capital guaranteed protection funds, bond funds, all of those funds used to be 1 year long term and 10% capital gains tax flat or 20% on indexation. Now, as you can see, once you put it like this, as you can see, there's a clear discrimination. It's more, Amit has mentioned about the fact that the banks have went and lobbied. I don't know whether they went and lobbied or not, but I can clearly see, even without banks lobbying, there is absolutely no reason why somebody who's buying gold should be under one kind of a capital gains taxation. Somebody buying real estate should be under the same capital gains kind of taxation, and somebody who's buying bond fund should be in something else. There's absolutely no reason for this. All he's done is something absolutely, totally logical. He has made, put them all at par. Now, what to do about equity, about non-equity mutual funds in case you are investing? As I said, to repeat, from our perspective, if you're a taxpayer, invest in tax-free bonds. If you want to buy bond funds, you have to time them. You have to select them. Out of 50, 60 funds, you have to figure out this is the 3-year return, this is the 5-year return, this is my distributor is saying, this is the wealth manager is saying, he may know, he may not know, he may have a vested interest, so there is a selection process involved. All of that leads to very, very low and subpar returns. Frankly, our study, which I've shared at various times in our Safe and Smart seminar, our study says over 2/3 of the time, bond funds do not beat FD even on a post-tax basis, even on favorable previous post-tax returns. So people can go and buy, but ultimately if they look at the statement over a period of time, the outcome is not all that great. For others, other than bond funds, which is the MIP and capital protection funds and so on, avoid all of these. These are non-equity mutual funds which now fall under this 3-year and 20% indexation business. We've always said don't buy them. So frankly, anybody who's followed our advice would have absolutely no issues in handling any of this, because he would not have gone into any of this kind of products. Avoid the following if you are investing yourself. So if these other things under any circumstances, whether you're doing it yourself, under somebody's advice, checking on the website, figuring out you're a do-it-yourself investor, or you're a client of a very smart wealth manager, doesn't matter. No matter what kind of investor you're in, the first three things are not worth it. They fall in the category of harmful or irrelevant products that are there, too many of them in the financial market. If you are doing it all yourself by looking carefully, of course, FMPs and debt funds are both avoidable currently. I'll give you the reason for this. The government has given you the chance to hold it for 3 years, claim indexation benefit, and do a 20%, pay 20% tax in it. That's only the taxation aspect. Ultimately, if you are earning a 2% return or a 3% return or a 5% return, it doesn't matter what tax you pay. You have earned 3% or 4% less than what you have earned free bond. So if your earning itself is low, then what you gain in terms of paying taxes is absolutely irrelevant. Because if you buy these bond funds, unless you are exceptionally lucky, unless you're able to choose correctly, your returns are not likely to be 8% or 9% for you to then claim on top of that the capital gains benefit of indexation and so on. 3 years is a very long time. It could well be that you decide, instead of listening to me, you very well decide that this is a fantastic opportunity for India. It's a golden period that's going to come, and Modi is going to change everything, and as a result of which interest rates will fall. So 3 years from now, the bond prices are going to shoot up, okay? Because interest rates will fall, and when interest rates fall, bond prices go up and bond funds do very well. Now, even if that is so, if that is your view, it could well be correct. Even if it is so, then you should not invest in a bond fund, but you should still invest in the tax-free bonds that I'm talking about, because those you can pick and choose, and they will go up exactly by the same amount, and if not, probably more, because the bond fund managers try to time. They have a mind of their own. They think their interest rates will go up, they sell, they think interest rates will go down, they go and buy, they try to do all this timing, which is why our studies show that even when interest rates are falling and bond prices are supposed to go up, even in that period, 30% of the bond funds do extremely badly. It's an incredible fact that people don't ask. So next time your wealth manager sells you a bond fund, or anybody suggests you buy a bond fund, you should ask, show me all of their performance over all of these years. Then only you will get a complete picture, rather than your mind being made to focus on a particular fund and its performance. All right? So under any circumstances, you are far better off buying a tax-free bond vis-a-vis a bond fund. Okay. Almost end of the program. Which stocks and funds to buy? Obviously, everybody would want to know. Fortunately, because we are going to get almost more of the same that we saw in the past at the macro level. I'm not saying that nothing is going to change. I'm saying a lot will change. But all those changes are not going to eventually get reflected in a lower inflation and lower interest rate. This is the only limited point that I'm making, although a lot of ground level changes you will probably see. The benefits will be targeted much better, the poor people will get, corruption will be lower, all of those things will happen. They are not material enough, they are not big enough to make the big changes needed to get that 24 paisa out of 1 rupee down, or that 20 paisa out of 1 rupee down. Those are big, monstrous challenges that we face, and it's nothing to do with a little bit of tinkering here and there. So we are going to get more of what we got in 2012 or 11 or 10, which makes our job really easy. More of the same in economy means more of the same in stocks. Good quality stocks, well chosen, are going to do very well. This is a picture. Rupee is not going to strengthen that much, which is why you're going to be doing extremely well investing in pharma, export-oriented pharma stocks, and you're going to do extremely well investing in software stocks. What has worked in 2010, what has worked in 2011 and 12 will continue to work very well, which is FMCG, pharma, and software. There was a possibility, briefly, in my mind, that this is a time for a lot of public sector companies, public sector banks, cyclicals, as they're called, a lot of industrial goods intermediate manufacturers, people who manufacture, let's say, ball bearing and so on. These are the companies which are going to do exceptionally well, is what I thought. They will still do well, because we saw the numbers, May numbers coming in. The industrial production was up to 4.7%, which was a significant jump over the same time last year. They will do well, because in any case, this government is going to be certainly better than the previous government. And in any case, you have seen 4 or 5 years of decline, and by natural law, there is going to be a natural process of uptick, because people have not invested, demand has grown, more and more people have more money to spend, companies are sitting on surplus cash, so obviously there is going to be some uptick. So all of these companies are going to do very well, but not as well as those high-class companies earning high return on net worth, which are to be found in these 3 particular sectors. Now that leaves us with one last slide. Sometime in May, or I think late May or early June, Mr. Rakesh Jhunjhunwala wrote an article in Economic Times. And he mentioned that we are going to have a structural bull market. Now, this term is never defined anywhere. You won't find the definition of this term anywhere. It essentially means that, the market will keep going up. It's net, it's what you saw between 1982 and 2000 in the US. In 82 to 2000 years, we had 18-year bull run. Similarly, what you saw in the 50s and 60s, from 46 to 64 or something like that, there was a massive bull run over there in the US also. Now, those things, to go back to the first principles, those things require a certain economic situation. These are possible only under these kind of conditions. You have government expenditure, you have reduced government borrowings, lower taxes, and an incredible revival of manufacturing and entrepreneurship, which is free, which is a justice system that is fair. This is what US had in the 60s, and which is what US had in the 80s. It has not happened so far. You cannot keep the faith, but keep watch on whether this is happening or not. Even if it doesn't happen, my belief remains that high quality stocks, as they have happened even in the worst kind of government that we saw in UPA 2, even then stocks are going to return 12 to 15% if they are chosen correctly. High quality stocks at reasonable prices, many of which we write in our magazine, many of which we also mention in our newsletter. So this is the picture. No big change. Equity investors are fine if they choose the right stocks. Debt investors, if you pay taxes, stick to tax-free bonds. If not, stick to bank equities. There's nothing more, nothing needs to be done. Thank you very much.